today on the Tear Sheet Podcast.
You could imagine a world where Square ends up becoming one of the biggest digital banks in the US and possibly abroad, because they have both the consumer side with Cash App, which has done extremely well and are acquiring customers at much lower acquisition costs than some of the digital challenger banks are. And they have the merchant side, and then have created a closed loop payments ecosystem from that.
Welcome to the Tear Sheet Podcast. I'm Shuman Bhattacharya. Today's guest is Michael Sidgmore. Michael is a partner at Broadhaven Ventures, which is a VC fund affiliated with Broadhaven Capital Partners, an independent fintech investment bank that's done over $55 billion in transaction volume. Broadhaven Ventures has investments in known fintechs like Credit Justo, Kayash, and MoneyLion. Its global portfolio includes some companies whose main business may not have initially been financial services, but have built out financial services products. He is also a venture partner at Goodwater Capital, a consumer tech VC that's invested in Toss, Monzo, Stash, and other well-known fintechs. Thanks for being on our podcast today, Michael.
Hey, Suman, thanks for having me. Great to be here.
So before we get into your investment thesis, it may be interesting to hear a little bit about how you got into fintech investing.
Yeah, absolutely. So I actually started my career at Goldman Sachs in London. I went to undergrad, did my university degree in the UK as well. So went to London School of Economics. And how I ended up in the UK was actually initially tried to play soccer, football in UK parlance, and ended up playing for a semi-pro team, or non-league team as they call it, but got injured, fell in love with London, and after a year of university in the US, decided to transfer to LSE, where I was exposed to the world of finance, ended up going to Goldman Sachs on their fintech investing team. It's called the Principal Strategic Investments team. So I've really been in fintech my entire career from starting at Goldman Sachs in London in 2012, 2013, right as fintech was starting to become a thing. And then moved to the startup world. Was an early employee at Mosaic, a solar finance business, and then iCapital, a tech-enabled alternative investment platform. So was early employee at both of those places on the sales side, and then met my partner from Broadhaven Capital Partners, and we started Broadhaven Ventures at the end of 2016.
So what excites you about financial services and fintech specifically?
It's a really interesting question at this point in time, and I think there's been a few waves of fintech now. So I think if we rewind the tape 10 years or so, and I think you could argue there were people in the early 2000s who were building fintech companies. They might just not have called it that back then. But if you think back kind of post-global financial crisis, when companies like Lending Club and other marketplace lenders and marketplace finance businesses were starting to take hold, kind of fintech 1.0 is really around disruption and disintermediation. So you saw companies like Lending Club or Zopa in the UK try to build businesses to disintermediate banks and financial services institutions by providing better customer experiences, lower fees, more transparency, which really was born out of I think a distrust of banks in large part from millennials. So you saw digital banks and challenger banks be created as a result of that. Then you kind of have gotten into the past few years where you've seen a lot of fintech incumbent collaboration. And honestly, I think we probably would have expected to see more 4 or 5 years ago. We would have expected to see more incumbent fintech collaboration and acquisitions, which we're actually now only starting to see. And then now I think this period of fintech is really about rebundling of financial services institutions, but it's being done by digital players. And those digital players may end up being the winners. So I think what really excites me about fintech are two things, and then there's a number of subcategories as a result of that. But one is rebundling of a bank by new fintech players. So you could imagine a world where Square ends up becoming one of the biggest digital banks in the US and possibly abroad, because they have both the consumer side with Cash App, which has done extremely well and are acquiring customers at much lower acquisition costs than some of the digital challenger banks are. And they have the merchant side, and then have created a closed loop payments ecosystem from that. So you can imagine worlds where those types of businesses end up actually becoming big financial services brands, as with some other challenger banks. So I think that's one really interesting piece. And then I think the other really interesting piece that we're starting to see emerge is non-fintechs becoming fintechs. So due to the creation of the infrastructure layer, really ushered in by Plaid, but then companies like Marqeta, which do card issuing, and other banking as a service or payments as a service platforms, you're really now seeing the ability for marketplaces, consumer tech businesses, SMB platforms like Shopify. They're enabling people to stay on the platforms where they do business, transact, or buy things, and they can offer financial services products to their constituents, whether it's merchants or consumers. I think that's a really interesting feature of fintech now, and that's really being enabled by the infrastructure layer.
So thinking about the great rebundling, as some people call it, and non-fintech companies or non-financial companies getting into financial services, what sorts of consumer problems do you think are the best places to put your investments?
Yeah, it's a good question. So I think, I think there's different ways to answer that question based on one, geography. So I think we can split that up into places like the U.S. and Europe versus places like Latin America and Asia, where there's very different levels of incumbent bank competition or penetration from those incumbents to consumers, and how that's affecting either ability for companies to create better user experiences or gain market share. And then I think you can think about different types of consumer problems you're trying to solve with financial services as well. So I think if I take those two pieces, so geographically, I think in the US or Europe, you're really going after a customer experience problem. And I think digital challengers actually have a chance to build very big businesses as a result of creating a decidedly better experience. There's a reason why businesses like Monzo or Revolut in the UK, businesses like Chime or Moneyline in the US have really gained large followings and large number of customers. The reason why is because they are creating a better experience than the traditional challengers or the traditional incumbents, and they're challenging that status quo. So I think they have the ability to create differentiated businesses, and you see them expanding horizontally into other areas. So like Monzo and Revolut also have business banking as well, in addition to consumer banking businesses. So I think there's now this kind of, we've gotten our customer base, we're going to expand horizontally, and I think that's a threat to incumbents to some extent. Now, I will caveat that by saying incumbents may be slow to move, but they're not dumb. Look at Goldman Sachs as an example, who you could actually argue is probably one of the faster moving incumbents, but what they've done with Marcus, both in the US and in the UK, is quite remarkable. I mean, on the consumer lending side, I've gotten to $1 billion of loans originated in 6 months. That took Lending Club over 4 years to get there, I believe. And then, on the UK side, they've gotten to 25 billion in savings in only a few years. So I think you're seeing incumbents realize they need to create better experiences by either building, or at some point, I think we'll see them buy. But that's, I think, what's defining the kind of US European landscape. In places like Latin America and Asia, I think what you have is a highly underpenetrated banking ecosystem where digital challengers can actually serve a whole population that is underbanked, underserved, and then expand horizontally and build really big businesses. So Nubank's an example of that in Brazil. They have, I believe, 20 million customers at this point. They're, I think, by valuation, at the very least, the highest value digital bank, close to $10 billion. They're now expanding into Mexico to expand beyond Brazil, which is a very large TAM. And then businesses like Toss in Korea. About a fourth of Korea's population uses Toss, which started out as a P2P payments business, is now a digital bank, and really going after an incumbent landscape that gives them a huge opportunity as a digital player, mobile player. So that's kind of enabling them to build a full-fledged digital bank and expand horizontally and offer a lot of things that others may not. So I think in some ways what we may see is digital challengers solve a number of core consumer problems, and they're no different than what traditional banks have solved. It could be consumer lending, it could be savings, it could be wealth management, it could be current accounts and banking. And I think, and then it could be into the business banking side of things. So I think you could see in other markets like Latin America or Asia, the ability for these companies to expand horizontally and build really big businesses.
So, can you get into some of the business cases there that you're working on with some of your portfolio companies?
Yeah, absolutely. So we've invested in both, traditional fintech companies. We're investors in Credit Justo, which is a small business lender in Mexico that's backed by Goldman Sachs, QED, and Kazek, amongst others. And then we're investors in non-fintech companies that have the ability to, in our view, offer financial services or financial products to their customers, like Covey, which is a car leasing platform in Brazil that leases cars to Uber and Didi drivers and partners with OEMs to do so. So they've created a fleet management solution. And then Nowports, which is a digital freight forwarder in Mexico and across Latin America that's enabling SMEs to and freight forwarders, shippers, exporters, and importers to track their shipments digitally from point to point. And I think what we see there is there's really a huge customer need on the banking side, on the payment side, and insurance in a number of these cases, and companies that are meeting customers at their point of need. And some of the companies we're invested in, like Covey and Nowports, are really meeting customers at a specific point of need. There are other companies we're not invested in, like Rappi, for example, which is similar to DoorDash, but for Latin America. It's a delivery platform. They're dealing with customers every day. They're meeting with them at a specific point of need. And from doing that, they establish a relationship of trust and of high engagement that I think many financial services institutions struggle to have. And therefore, I think the thesis there is that these companies can be the ones to provide financial services offerings to them, to their customers, because they're already engaging with them in something that they need to use either every day or quite often. So, it's not too far-fetched to think that a business like Covey, they're enabling drivers who can't otherwise get access to a car because they don't have a credit score or they don't have a bank account to be able to get access to drive a car for Uber or Didi. This is their first opportunity to get access to a car on a weekly lease through Covey. They can then, once you have their income stream and you are the ones paying them, you can do a lot of other things with them. So I think that's where we get excited about thinking about kind of solving consumer problems that may not be specifically fintech related, but that can become fintech related over time. And I think what this goes back to is really the point about under penetration of banking services in a place like Latin America, where, in Mexico, 30 some odd percent SME credit penetration. There's sub 15% credit card penetration on the consumer side. So there's really big opportunities to provide financial services to a number of people who just have historically not been served by financial institutions, or in some cases don't trust financial institutions.
What are some of the lessons from the Latin American region that you feel are applicable to a market, for instance, like the US or the UK?
Yeah, it's a good question. Kind of thinking about that in reverse, because what we've, I think the past few years of fintech and tech more broadly in a place like Latin America is a lot of people thinking, how can we take what's been done in the US and build the XYZ in the US for Latin America or for another region? I think you can think about that in reverse, because in some ways, the fact that LATAM companies may not start out in financial services, but are creating embedded finance platforms. I think there's a lot for US fintech companies or non-fintech companies to learn from what these non-fintech companies in Latin America are doing to meet customers at their point of need, solve something for them, and then figure out how to offer financial services products as a result of that. So I think that's one thing to learn. I think this may be in part due to exchange rate, but I think LATAM founders tend to be relatively frugal and conscious of their burn rates as well. I know it's cheaper, cost of living is cheaper, it's cheaper to hire there. But I think we've been, on the whole, really impressed with how founders are thinking about building their business. We often, very early on, hear them think about, how do I get to monthly profitability? How do I think about running an efficient business? And I think, from a venture capital perspective, which is just as important to the founders as it is to VCs, is how efficient is a business. So for every dollar you invest, how do you make sure you're getting multiples of that dollar in return on invested capital from a revenue perspective? Because that's what creates real enterprise value. And then that means you obviously have to raise less capital. So the less capital you raise, the less dilution there is. And that ends up benefiting everybody, most importantly, the founders and team who are working so hard to build great businesses.
So quickly, do you think that the challenge or the lesson that can be learned from non-financial companies going into financial services in Latin America and taking those lessons to the US and the UK, do you think the challenge is technology related? The lessons are technology related, or do you think they're user experience related?
I think they're more user experience related, just because, it really is, people who are building businesses that may not be fintech businesses, they're thinking about how to solve the kind of first consumer problem is how do I build a business that consumers need? And then once they've solved that, then they think about, okay, what are the other things that I can do? And just to be fair, I mean, there are plenty of US and European companies thinking about how they can create embedded finance solutions. So it's not that US or European fintechs aren't thinking about this, or non-fintechs aren't thinking about this and expanding into being fintech companies as well. But I do think that, LATAM founders who are building businesses like this have one eye on building a great business that's focused on that core product, but they often also think about themselves as fintech companies. So a lot of the founders we work with, you wouldn't normally think of a logistics business as a fintech company, but I think the founders of Nowports would say, we are very much a fintech company as well, and they feel that that's really important to their DNA and the business they're trying to build. So I think that's that's a really important piece of it. The one piece I will say as an investor that I try to be very conscious of is, we are fintech investors investing in non-fintech companies at times with the idea over time that they become a fintech business. I think we try to be very respectful and careful of how much we feel the company should be pushing and building out fintech products or services, because the reality is there's so much room to run in many of these cases in building a great core product that there's a time and a place to build a fintech product. And it's about balancing, how much of your core business have you built and doing a really good job of that and creating great user experience, making sure customers like the product, use the product, and are retained. Then it's about building a fintech platform or set of products and services. So I think we've had to really balance that. And I think that's, at least for us, kind of to answer your question about what are some of the lessons learned. I mean, certainly for us, one of our lessons learned is make sure that, we really balance the need and desire for building fintech products, fintech attached products on a non-fintech platform at the right time and place, and not rush into that, because you can build a really good core business, and that's important too.
One of the things that we've written about a lot at Tearsheet is this concept of embedded finance. And I think you've highlighted some of the challenges with trying to attach a financial services underpinning to a non-financial services business. And I think you could argue that, particularly now during the coronavirus crisis, as more people look to digital services for not only financial services, but retail and other things, that, the effects of COVID-19 are pushing that digitization. What do you think are going to be some of the lingering effects in financial services that will last longer, even beyond the pandemic?
It's a great question. We spent a lot of time thinking about this because as early stage investors, we're not just thinking about what's going to happen over the next 1 to 2 years, but what's going to really have staying power and impact consumer behavior, enterprise behavior over the next 3 to 5 to 10 years. So I think I'll answer that question in kind of 3 areas. So one is digital transformation of the enterprise. 2 is digital financial services and how that impacts the consumer. And 3 is the changing consumer behavior. So I think this virus has ushered in an awareness about things in different ways, which I'll touch on as well. Kind of to touch on the first point, digital transformation of the enterprise. So I think because people are now work from home, they have to conduct business in different ways, have to do it virtually and digitally. I think what you're seeing is enterprises realize they have to transform their own businesses digitally and do that really fast. So we had a business actually that just got acquired by DocuSign this past week called Live Oak Technologies. They're a virtual business platform enabling large enterprises, banks, so some of the top banks in the U.S., insurance companies, or investors and big customers of Live Oak. And what we saw, particularly during the pandemic, was that these banks know they need to find a way to communicate with customers and complete complex transactions or negotiations virtually. And Live Oak was enabling them to do that. They are now they now will be embedded into DocuSign to do things like complete complex transactions, like a 401k rollover form, or onboarding a wealth client virtually, but also get into things like remote online notary. So I think you will see increased digital transformation within the enterprise. I think you will see that in two ways. One is you'll see companies realizing they need to buy software products, fintech software products, to transform their own customer experiences and do that quickly, or they'll acquire, or tech companies like a DocuSign will acquire businesses like Live Oak to do that and provide those services to the enterprise. And then I think the other piece of that is it won't get ripped out, because once it's there, it's a decidedly better experience and it won't get ripped out. So I think that's, over the long term, that's going to be a really interesting trend. On the consumer side, I think there's two things. So one is I think that people are going to adopt digital payments and digital banking over the medium to long term. And the reason why is they're going to realize how frictionless of an experience it is. And it may even change cultural behavior in places like Latin America or Japan, like you mentioned. We're investors in a business called Cash, K-Y-A-S-H. It's a Japanese P2P payments and digital banking business. And Japan, like much of Latin America, is very much a cash-based economy. But we're seeing, we're seeing a shift to, increasing number of digital payments because of COVID, and in two ways. One is just people aren't going out and transacting as much in person, so they have to use digital finance to do that. Number two is I think you see an awareness of COVID itself, that people don't want to put their card into the card reader because that means they're touching the card and there could be a transmission of germs. They don't want to they don't want to hand cash over to somebody else. South Korea actually banned the circulation of notes for a few weeks. So I think when you see things like that, I think digital payments is going to benefit from this, and over the long term, I think should give consumers a much better everyday financial services experience. And then three is, just changing consumer behavior in general. And I think particularly relative to COVID and the very unfortunate impacts that this has had on society as a whole, it's going to create this awareness that's going to make people do things in different ways. So, things like planning for the bereavement process and thinking about kind of other parts of life are things that people are going to do. I mean, on that point, we actually just invested alongside a number of other growth investors, including Highland Europe, into a company called Fairwill in the UK. They're the leading digital wills, probate, and direct cremation business that's really helping people have a much cheaper, better, and digital end of life planning process. And obviously there you're seeing people really start to think about, I need to do my will. I should think about that. And it's a very unfortunate reality that we live in today because of what's happened with COVID, but it really is making people think about this. And there are companies like Fairwill who, I think what got us so excited about what the team is building there is they have built a decidedly better technology experience, but they've done so with such an incredible amount of empathy, and they've screened for that in who they've hired, how they've built their product, and how they communicate with people, that you're going to see technology solutions crop up that really enable people to change consumer behavior and help them change consumer behavior as an impact of COVID.
So you've talked a little bit about how COVID is affecting the your course of how you invest in companies, the priorities around digital and automation instead of in person. Can you tell me a little bit about how the pandemic has affected the flow of your day-to-day operations? Like, for instance, is it harder to close earlier stage deals? Is it easy to carry out your business over a series of Zoom calls? How has it affected your day-to-day?
Great question. So for us, from a day-to-day operations in terms of running our fund, my partner and I communicating, we actually started our fund in a remote work setting. I'm based in the Bay Area in SF. He's based between Chicago and New York. Our bank, our biggest offices are in Chicago and New York, so he's between those two offices. So from a day-to-day running of the fund perspective and evaluating founders, that hasn't really changed much, other than we usually would like to meet founders in person, and we'd never, up until a few months ago, our past two investments we have done remotely, but up until that, we'd always met the founder in person. I think we think that's important, right? It's important to build a relationship of trust, getting to know somebody, spending time with them, and then getting to know us just as well. And I think there's nothing that replaces in-person meetings to do that. So up until the pandemic, we hadn't done that. We have made investments during the pandemic. So Fairwill, which I mentioned, was totally remote. That Dan, the founder there, actually closed his entire round remotely and had a ton of interest from a number of large VCs. Highland, who was the lead of it was a 20 million pound round, Series B, totally remote. And I think it's totally doable to do this. Cash in Japan, we also did as a remote investment. The founder there, Shin, closed a $45 million round remotely. Now, there were previous investors who had invested before and met Shin, who had invested as well. So it makes it a little different. I think a few takeaways from that, though. One is, I think it's totally possible. And in some ways, you can have, although you can't meet in person, you can have more conversations over Zoom in a quicker period of time because you don't have to deal with people's travel schedules and things like that. So you can actually accelerate conversations a lot quicker. I don't think it can replace in-person conversations and meeting and spending time either with the team and the founders or in the ecosystem too. I mean, we really like to spend a lot of time in the ecosystems we invest in. So like LATAM, we had one investment down there from 2017, Credit Justo, where we co-led a seed round with Elevar Equity. And we started going down to Mexico City because we were on the board. So, that then cropped into, 6 investments down in LATAM over time by spending time in the ecosystem. And I do think that's important. So you can't replace that. But I think it certainly can be done. And we're really excited about the founders and teams we're partnering with in those cases. I think the other lesson learned, which hopefully is helpful for founders as well, is in both of the cases where we invested, we knew the lead VC from the last round or the current round very well. And that made it easier for us to get comfortable with the business because we had a relationship of trust with that lead VC. So one thing I've shared with founders, some of our founders, other founders who I've talked to, is that, really make sure you have a great set of VCs already in the business and make sure they're spending a lot of time helping to get new VCs up to speed with your business. Because I think in a world where we may not be able to meet with founders for quite some time, being able to trust an underwrite from a VC who we know well or have done work with, that I think will make it easier for a new investor to come in and be able to underwrite an investment with a founder that they've never met in person.
Well, Michael, thank you very much for being with us today, and we look forward to following your progress.
Thanks a lot, Suman. Really appreciate you having me on.